Yeah, this
Staying
is,
home.
yeah, it's pretty thinned out now. Pretty thinned out now. I think so.
This is good.
And everyone's been saying how hot it is, just so you know.
All right. Get a,
Maybe we'll
get a
get
You guys
schwitz
ready?
in.
Do I?
sweating. Yeah, I guess. You want to, yeah.
Someone have a glass?
Hey, it's not my show.
Hi. We're just trying to get everybody's attention. I think there was a break, but I've been told we need to keep on schedule. Giving everybody a minute. Thanks so much for coming today. My name is Hillary Corman Kirsch from State Street Investment Management, and we have a great partnership here with Astoria, so we're very happy to be here. I was going to introduce our next panel. Mike Aroney of State Street Investment Management is the CIO and the head of specialists. He's responsible for expanding State Street's footprint and thought leadership efforts through contributions to financial news media, speaking engagements, and client interactions. You've probably read one of his market outlooks or an edition of, quote unquote, it's called Uncommon Sense, which I love that title, where he shares his unconventional perspective to help investors think beyond consensus. He earned his CFA and is a member of the Boston Security Analyst Society. Please join me in welcoming Mike Aroney. And to his right, we have Dan Skelly, Managing Director and Head of Market Research and Strategy at Morgan Stanley. Dan is a member of the Global Investment Committee with Morgan Stanley Wealth Management. The team manages 8 long-only equity portfolios within the separately managed account platform known as MAPS, or Managed Advisory Portfolio, with over $50 billion in assets under management collectively. Dan joined Morgan Stanley in 2005 in the Global Wealth Management Program and is a regular guest on CNBC and Bloomberg. So I'll turn it over to you guys.
Thank you so much. Thanks for having us. And good afternoon. Thanks, everyone, for joining. I'm excited to be with Mike here and go over some of the outlook and positioning comments from State Street's perch. So happy to be with you, Mike.
Yeah, it's good to be here.
Likewise. So this is obviously going to be the 3rd year in a row of above-average gains in equities. What's your outlook for the remainder of the year?
So Dan, I've been describing myself for a while now as uncomfortably bullish. And so I think kind of when we tackle the bullishness part, I think from my perspective, there's a few things. The One Big Beautiful Bill Act, I think, will both help stimulate the consumer spending. So incrementally, you're looking at about $150 billion tax refund season, and then February to May next year, that I think will flow right through into consumer spending, for example. Of course, already now, there's been about $100 billion of tax savings for companies retroactively and their ability to expense R&D immediately. That's already happened, and I think that'll continue to go. So when I look at the One Big Beautiful Bill Act, I think there's going to be a fair amount of fiscal stimulus. The second thing that fuels my bullishness is around monetary policy stimulus. So I've been expecting the Fed to cut interest rates throughout all year, and ultimately I think we'll get 2 more rate cuts to conclude this year and possibly 2 more next year. I think that they're going to move to a more neutral posture, and as a result, you're going to get monetary stimulus. I think as has been discussed throughout the day, we're kind of kicking off earnings season. Only about 12% of the companies have reported, but 86% of them are beating. If we look at a blended rate from FactSet, it looks like earnings are going to grow by double digits again. And ultimately, when I put that all together, it's an attractive backdrop. You think about the AI spending, the consumer's in good shape, the tax refund season I talked about next year, the North America is hosting the World Cup, and then ultimately the U.S. will be celebrating the 250th anniversary of the signing of Declaration of Independence. I think all of that kind of fuels that optimism that this rally could keep going.
Sure. It's a great rundown, Mike, and we're going to come back to AI and the Mag 7 in a moment. But despite that kind of rosy outlook, just what are the risks out there that you see that could maybe upend some of the bullishness.
So that's the uncomfortable part, right? And it's news to no one here that valuations are stretched. Positioning stretched, valuations are stretched, price levels are high. Gold has hit 47 all-time highs this year. The S&P's hit more than 30 all-time highs this year. And it's not just a US phenomenon. European stocks, Japanese stocks, South Korea, many places around the world are hitting all-time highs from that perspective. So as an investor, of course, I'd like to be buying things at lower prices and better valuations. But we know that valuations are a poor indicator of short-term performance, but it just contributes to that discomfort. Credit spreads are tight. Most measures of market volatility are fairly complacent. So there's that part. And there's a whole other kind of set of things I would put in the structural camp. And I won't go through them in a lot of detail. But when we think about kind of the investing framework that's kind of unfolding, we're remaking the global trading system. The US has asked the world to share more equally in the burden of its global security. Of course, global defense stocks have skyrocketed as a result. But there's some risks to that. Labor markets are in a curious kind of balance, per Chairman Powell. Lower taxes, less regulation, permanent fiscal deficits, not only here, but in a lot of wealthy countries, all have implications on the economy, inflation, interest rates that are highly uncertain. So a lot AI, like you said, we'll talk about it. Kind of, is it is it an opportunity? ROI has been elusive. So a lot of those things are kind of unfolding in real time that I think induce an element of uncertainty that hasn't really, not that it hasn't existed, but just a different level when we look at some of those structural things that are really changing. Deglobalization, you could throw in that laundry list of things that are just, we're not so sure about.
Sure, and that's a great segue because trade and tariffs were obviously a huge cloud on the markets this spring and a source of the big panic in April. We've heard this refrain that tariffs are everywhere but the data, which I think is a catchy saying. But could tariffs figure back into margin risk for earnings or inflation risk? How are you viewing that risk factor today?
Yeah, so perhaps like you all at Morgan Stanley, I viewed the tariffs, the fears of tariff inflation as highly exaggerated, and the kind of component where it would result in lower growth, again, the fears were worse than what I was expecting. Now, I think for me, what's kind of interesting, or what could be interesting here, is that I acknowledge that effective tariff rates in the US last year around, let's call it 2.5%. They're likely to settle around 15% when all is said and done. And I often joke that, look, I was a finance major, I'm not good at math, but 15 is a whole lot higher than 2.5. And those are the highest levels in 90 years, since the 1930s. So if they remain permanent and for longer, and we start working through the inventories and the stockpiling, do you start to see price increases flow through? Or if companies can't pass them along, does that start to reduce corporate profitability? I think there's a risk to that, but I actually think we're going to be okay. But it is something to keep an eye on.
And then just as a follow-up, clearly tariffs are going to go through the Supreme Court review in a couple of months. I had assumed that was increasingly going to be withheld or upheld, rather. I've heard in more discussions in the last week or two, some people are speculating the Supreme Court could strike down the ruling. So, I mean, how are you looking at that potential catalyst one way or another?
Yeah, so I think that you can see already that the Trump administration has got a plan B in terms of some of the things they're doing with 232, for example, some of the sectoral tariffs that they're able to do. There's at least two other parts of the law that they can use to enact tariffs. I think the biggest impact right away will be if, in fact, they have to do some type of tariff refunds. We saw that when the appeals court ruled against the Trump administration, that long-term rates went up and the market suffered some volatility for fears that you wouldn't have this tariff revenue to offset some of the fiscal spending on the One Big Beautiful Bill Act. So I think that would be the immediate reaction, but I think that the Trump administration already has a plan B and how they're going to kind of reintroduce the tariffs should they lose in the Supreme Court. Interesting article over the weekend in the Wall Street Journal, essentially saying that kind of under the surface, the Trump administration is kind of not backing down, but really watering down a lot of the tariffs, a lot of exemptions, product exemptions, deals if you do foreign direct investment, things like that. Ultimately, you get a deal, that type of thing. So it's really hard. And I think that is the direction of travel, which is why I think trade is in a position where we can move forward and not backward.
Very helpful. I saw that same piece and was thinking very much along those lines as well, in terms of kind of cushioning the maybe a next scenario taking place.
Yeah.
There's always another deal around the corner. We've come to learn that.
Right, and I feel like over the weekend and more recently, they've been signaling that they expect, right? So Trump has a few big meetings overseas coming up. Certainly he may meet with Xi Jinping at the end of this month. And I think he's in Malaysia. And so they're working on deals to announce when he'll be there, like a trade deal with Malaysia. Now, again, I don't know how much trade we do with Malaysia generally, but ultimately there's a number. The Association of Southeast Asian Nations Summit is coming up. And ultimately, I think that in anticipation of that, there's expectations that a few more deals may be announced. And again, I think that that'll kind of push the trade tensions down. Of course, over the weekend, Trump was suggesting he knows that 100% tariffs on China isn't sustainable for anyone. And again, I think markets have quickly kind of calmed as a result.
Makes sense. Mike, some really good color there. So let's drill down for a minute on equities in the U.S. specifically. So as you alluded to a minute ago, it's been a broader, globally diversified leadership group this year, maybe for the first time in 10 to 15 years. But within the U.S., the Mag 7 has been a concentrated leadership group for a while. Maybe this year taking a little bit more of a solid approach, not the only game in town.
Yeah.
We've certainly seen some broadening out with the Fed easing expectations and so forth. But I guess just broadly speaking, Mag 7 is still a big concentrated bet. What are you telling investors to do in terms of hedging some of that concentration risk?
I think this is where we may see some alignment between our two firms. And I think from our perspective, we've been encouraging investors to think beyond the Mag 7 for a while. So when we meet with clients or we gather their portfolios, we'll do a lot of analysis like many firms do in terms of scenario testing and others. As you said, right, most folks are overweight US, most folks are overweight US large cap, growth, tech, Mag 7 from that perspective. And they have some concentration risks. And you may see it perhaps across Morgan Stanley advisor portfolios. Who knows? So we've been encouraging investors to think about ways to address that concentration risk. And again, it's not that the ways are unlimited. So of course you can think about international, moving assets from the US overseas. You can think about moving down in market cap. And of course you can think about factors or equally weighting, however you want to describe it, smart beta. So if we take a few of those kind of in kind, for us for a while now, for the last year, we've been recommending an equally weighted tech index. And so not equally weighting the S&P or equally weighting, sorry, John, or equally weighting the market, but rather equally weighting technology. So we have a product, John said it was okay. He encouraged me to give you tickers, XNTK, which is an equally weighted tech leaders index. Mag 7's in there, it's annually rebalanced in December, equally weight, and ultimately it gives you broader exposure. This thing's outperformed the S&P, it's outperformed Qs, it's outperformed all the AI thematics, it's outperformed all kinds of things. And ultimately, it has exposure to ASML, Taiwan Semiconductor, Alibaba, where some of those other products don't. And so this has really outperformed significantly. So we've been saying, look, we love earnings growth, we love AI, but the biggest spenders aren't always the biggest winners in terms of that CapEx expenditures. And the hyperscalers now account for more than 30% of capital expenditures in the S&P 500. That number's up from 19% in 2019. So again, historically, the big spenders, they lay the foundation for everyone else to come along, especially in technology, to find a better way, a cheaper way, a newer product, a better solution. And so from my perspective, this gives you exposure to that, and it's been rewarded with performance. So that's that equally weighted kind of component. Another thing is to look international. I bet very few people in this room know that the Euro Stoxx 50 so it's the Dow of Europe, the big leaders of Europe. That index has actually outperformed the S&P 500 on an annualized basis over the last 3 years by 5.5%, almost 30% returns. So incredible results. And it's got more industrials and financials. Tech's kind of much further down the line.
Sure.
So again,
5% of that index is tech,
yeah,
right?
yeah,
Small, right?
right. So kind of, again, a way to diversify away from concentration, but still not give up on returns. Cheaper, trades at 17 times forward as earnings versus 25. You certainly have ECB rate cuts that have helped. You have more fiscal spending in Europe, a tighter fiscal integration. Certainly Europe is at least giving voice to the notion that they're going to follow Mario Draghi's kind of framework on becoming more competitive, better defense spending, more innovation, less regulation. We'll see. I get it if you're skeptical. Europe has a habit of shooting itself in the foot, but it's cheaper and there's some real tailwinds behind it from that perspective. And then finally moving down in cap, and I'll do that one quickly. So rather than go equal weight, we like small cap. So small cap is now going to benefit from the fact that you'll have Fed rate cuts. So interest expense for small cap companies should be lower. It should flatter their profitability. You have the One Big Beautiful Bill Act. When we look at that, the one change in that One Big Beautiful Bill Act was that you could expense 30% of earnings before interest and tax. Now you can do 30% of EBITDA, including depreciation and amortization. When we look at depreciation and amortization, small cap companies have twice as much as large cap. So we think this will flatter their profitability. And finally, Chairman Powell was out just last week signaling the end to quantitative tightening and a loosening of financial conditions. We think all three of those things should help small cap at a time when they're cheap. And the key ingredient here is that their earnings growth is expected to catch up with large cap last year. The reason small cap has underperformed for so long, almost 9 consecutive years now, is because earnings growth has been faster in large cap, but that may begin to change in 2026.
Excellent. So great overview on equities. Let's shift gears, Mike, and talk fixed income for a minute. And clearly a little bit better this year maybe on the duration front, but the last 3 or 4 years have been incredibly difficult. You've got tight credit spreads trading at 1998 tights at the moment, so valuation is very challenged. And then I think just in terms of relative volatility adjusted comparisons, the S&P is running like a 3.5 sharp since April, and I think we've had a 3% max drawdown and a 30% plus return as we were just talking about. So with all that being said, where do you guys say you should be positioned for fixed income going forward?
Right, and I know, look, Jeff, you heard it from Jeff Sherman this morning for those that have been here kind of throughout the day. So at least from my perspective, we continue to be a bit cautious on the long end of the curve. We expect for a lot of those that list of structural items that I mentioned up front, remaking the global trading system, kind of changing the way that global security works, the curious balance of the labor market, which is fueled by demographics and immigration reform and AI, and of course deglobalization. We think a lot of these things, permanent fiscal deficits, will likely keep the long end of the curve a bit higher and more volatile than the market thinks. Now, we're not suggesting we expect that we'll go back to early 1980s levels or 70s levels, but we think both inflation and rates may stay a bit higher and more volatile and stickier than the market expects. And with that poses problems for long-term interest in our opinion. And of course, the supply of kind of sovereign debt globally is exploding. And so folks are demanding a higher premium to own it. So we think the long end, we're reluctant to extend duration. Most of us grew up 82 to 2022. It was an incredible bond bull market. I'm not saying it is over, but I'm not saying it won't recover, but it's been an incredibly long time since the ag has hit another new all-time high, and we think that this could last a while longer. So we prefer the belly of the curve. We prefer kind of active management. So of course, many of you know that we have a more than decades-long relationship with Jeff Sherman and Jeff Gunlack and the Double Line team. We were the first to launch an active ETF in the loan space, SRLN, with the Blackstone team. It has a sister product, HYBL. So we like a mix of active management, given that credit spreads are so tight, given the fact that long rates are likely to stay higher and more volatile. We think you need active management to help you navigate what's an increasingly difficult time for fixed income. We prefer the belly of the curve and some credit because given some of the bullishness that I mentioned, we don't anticipate a recession. So having some credit with a bit of a carry will work. Companies are profitable, interest coverage ratios are high, default rates are low. So you can pick up some carry there, but certainly the last week has demonstrated it's not for the faint of heart. You want to make sure you have someone navigating the first brands, the tricolors. And again, I get some of it's not in private credit, some of it's bank, et cetera, but just generally there's a few kind of cracks or risks that are starting to form. So you want to ensure you have someone kind of doing the homework there.
Absolutely, we agree on that front as well. So, Mike, beyond traditional stock and bond investing, maybe touch on other changes or amendments folks should make to their asset allocation amid this landscape you described.
Yeah, absolutely. So from my perspective, again, if our thesis holds that the economy's not going to enter recession, earnings are still strong, consumers still spending, from that perspective, you have fiscal stimulus, monetary stimulus. Of course, we're kind of overweight stocks. And as long as that holds true, stocks are a good inflation hedge. That's proven to have been the case this time and almost virtually every time. And so as long as the economy is growing and earnings are growing, stocks are a great place to be. Now, under those same conditions, though, bond allocations become tougher. And I think this has been a theme throughout the course of the conversation today, some of the kind of smart leveraging conversation, the last panel, for example. So from my perspective, if in fact that thesis holds true, where longer rates are expected to remain higher and more volatile, where inflation may be a bit stickier or kind of stick around for a little bit longer, then bond allocations will remain a challenge. And so, of course, we already went through kind of some of the recommendations there, but you need an alternative. And so from my perspective, an alternative to those bonds are some of the things that have been talked about today. So real assets, including gold, so infrastructure, commodities, natural resources, real estate. Some of these things, like real estate, will benefit from lower interest rates, for example, and have some income. So you don't have to give up all the income that bonds generate by going to this real asset category. And so I think that that's kind of important. Certainly, Chris Ward was up here earlier today, and some of you will be reading in the headlines and in the news and things that we partnered with Bridgewater to bring the all-weather portfolio in the ETF, all W, for example. So these, I think, so we talked about smart leveraging and the exposure to tips and global bonds and to gold and commodities that exist in that framework, and using smart leverage to get you a greater capital to more effectively balance your asset allocation. So we think these are all great solutions: gold, all W, real assets. So oftentimes I'll meet with a financial advisor and they'll say, well, I have tips, I have gold, so I have that inflation hedge. I think you have to go one step further. I think you need kind of a diversified exposure to real assets. Let's call it roughly 10%. There's been lots of talk about 60-40, 60-20-20, all different types of things today, using smart leverage. So we kind of use that framework. It may not be 60-40 anymore. Maybe it is 60-30-10. 10 to 15% in this other category with those characteristics should be a nice complement. And interestingly enough, a real asset portfolio has actually outperformed both the Ag and the S&P so far this year.
Excellent. So just to kind of summarize, stocks are expensive, but there's selective opportunities. Bonds are increasingly in this new world, coming out of the 40-year bull market with all types of structural impediments, perhaps. And then there's a couple of ideas you mentioned on the alternative front, on the real assets front. Are there any kind of other obvious investment opportunities that when you meet with advisors, it's maybe things they haven't heard of or things that take them a little bit by surprise?
Yeah, so I think from my perspective, when I think about this question, I think about it as kind of for those of us that have been around, back in 2008, 2009, coming out of that period, we'll remember the high yield spreads were so wide, it was like the obvious, at least in hindsight anyway, right? Might have been some trepidation to take that risk at that point. But in hindsight, in 2009, high yield spreads were so wide, it was that fat pitch that investors get very infrequently. And institutions and wealth advisors.
Was it 15% over or something like that?
So, yeah. And folks, not that they loaded up, but certainly took advantage of that opportunity and benefited handsomely. Today, there just isn't that many opportunities. As I mentioned up front, right? It's not just that US stocks are at all-time highs. Japan, Europe, South Korea, so many different places. Credit spreads are historically tight from that perspective. So it is difficult. So from my perspective, we've been encouraging folks to embrace the benefits of diversification. If you haven't owned international or emerging markets in a while, you've given up on it, you don't own any, you're massively underweight to ACWI, it's probably time to kind of pare back some of those underweights, maybe close that gap a little bit. Use things like all W and gold as diversifiers. Now, if I had to take a bit of a flyer, I'd give you kind of two quick ideas. One's on healthcare. So healthcare is a dog. It's essentially, in the last 10 years, healthcare has underperformed in 8 out of the last 10 calendar years. The only 2 that outperformed was 2018 and 2022. What do those things have in common? 2 down years, right? The defensive properties. Healthcare spending as a percentage of GDP has stagnated. Higher interest rates have certainly hurt. China has a tremendous amount of experience in biosynthetics and biotechnology that's competing in the US from that perspective. Regulations have been difficult, M&A activity and the like. We think this may finally be changing. So you have this question before you. Is this a falling knife? Is this a value trap, or is this an opportunity? So in 11 out of the last 13 midterm election years, healthcare has outperformed the market on an annualized basis of 800 basis points. Now, we know history doesn't repeat itself, but it can rhyme. So they're inexpensive, unloved. If you all work in the ETF and you're thinking of ETF flows have been outflows for healthcare dramatically. And now we think lower rates, lighter regulation, the ability to do expense R&D will help. We think the clarity on kind of the future of most favored nation pricing, as well as some of the remaking the global trading system and kind of bringing back some of that manufacturing, some of the investments that many of the large pharmaceutical companies are making, we think provides clarity to that outlook. We think healthcare and more specifically biotech could be an interesting opportunity kind of in that dynamic, given some of the history, given the fact that it's unloved, underappreciated. Think of it this way. This summer, the market cap of NVIDIA almost eclipsed the entire market capitalization of the healthcare sector. And so healthcare as a percentage of the S&P hasn't been this low in 25 years. So when we think about contrarians or unloved or kind of the things, it's kind of an interesting opportunity. And finally, sorry, I'm on my soapbox here. Think about the demographics, right? Think about the kind of the wealthy countries. So demographics are kind of everyone's aging. The search to end terrible things like cancer, heart disease, dementia, the research for that continues. Ultimately, we're living longer, so preventative care, curative care, all this feeds into a more structural long-term. But I acknowledge healthcare has been a dog, but it may be time to start to look at it. Over the last 3 months, healthcare has outperformed the S&P 500.
Excellent, excellent. Fantastic. Well, we still have a little bit of time to get the audience involved. So if there are any questions for Mike, happy to entertain them now. And looks like there's one over here.
Oh, of course. Yeah, absolutely. So the Euro Stoxx 50, I said that it was like the Dow of Europe. So FEZ is the Euro Stoxx 50 spider ETF from that, and it matches that index. So FEZ.
Excellent. Happy to take more questions for Mike. There's one over here in the middle.
For foreign equities,
The mic coming to you, sir.
For foreign equities, do you have any opinions on unhedged or hedged dollar exposure?
So it's interesting. I get this question a lot, and I know Jeremy Schwartz was here earlier and things. So I grew up primarily in the institutional world, and the kind of recommendation that I give is more make a decision to hedge or not hedge and live with that decision. Then choose a kind of a level to hedge. And I'll tell you this, when working with institutions, most institutions go 50%. They typically hedge about 50% of their non-US exposure. Their consultant helps them with that work. And ultimately, that's where they end up and manage to that. And so that's what I think is the most prudent thing to do. And then, of course, rebalance to that as it changes. What I discourage is trying to make predictions about the currency market and trying to time that hedge. So again, I bet there's differences of opinion in the room for sure. But when you're asking me, that's kind of the way I would think about it. So choose to hedge or not hedge, knowing that as a US-based investor, most of your returns in international come from currency appreciation. So if you're going to hedge it, you're basically taking some of that away. But if you don't want to have the whipsaw, that's fine. Like I said, institutions, they do about 50%. And so that's one way to do it. We did see when unhedged ETF or hedged ETFs came out, folks really tried to time it. Assets ballooned up, they got caught on the wrong side, assets went down. I discourage that completely.
We can get you a mic if you just wait one sec. Coming at you. you.
I think a healthcare trade idea is a very interesting one. I know you talked about biotech, but what do you think about the other subsectors like the pharmas or the insurance or
Yep.
the hospitals?
Yeah, absolutely. So it's interesting, right? Of course, I'm up here representing SPDR ETFs. There's the 11 kind of select sector ETFs, of course, XLV healthcare. And then we have the industry suite. And that's where, a lot of investors over the years have switched because underneath there's a tremendous amount of dispersion at the industry level. And so your question's a good one. You're probably like, thanks. And so when I think of this, I prefer the growth-oriented sectors that lean into some of those structural tailwinds that I mentioned: biotech, life sciences, equipment, services. And I'm a little less enthusiastic about mature pharmaceutical companies, managed care companies, insurance from that perspective. So I would prefer to lean into some of the more the growth-oriented from that standpoint.
Mark, we'll get you a microphone on your left.
Thanks. Hey, Mike, I hadn't heard you talk too much about power. I'd like to know more about where you and your thoughts research-wise and also actually application-wise in the portfolios, where we would expect to see you start to apply some of that theme, and just some of your comments on that would be helpful.
Absolutely. So as part of the AI kind of build out, right? It's again not news to anyone. The data centers and other kind of items that are going to be needed to fuel all these large language models and all this information, and the infrastructure investments that have gone in behind them have been incredible. And utilities is one of the areas that has outperformed the market this year, right? A traditional kind of stalwart, if you will, on the defensive side has done exceptionally well from that standpoint. So it's clear that there's a significant amount of investments that are being made to modernize the power grid. And investors have reaped the rewards from that in a lot of ways. But similar to the question on healthcare, right, there's kind of government-regulated utilities make up about 50% of utilities. And I would avoid those. They're more defensive, right? They pay dividends. When rates go down, that's good. If the market were to suffer a bear market, utilities should do well from that perspective. But their prices are regulated by governments, by the states, et cetera, and there's not a lot of growth there. So it's really that other side, right? And everyone was perusing Barron's this weekend. I think it was Constellation Energy. They interviewed the CEO, right? And so ultimately, there is a growth opportunity there. And just so from my perspective, I think that's currently reflected in a lot of the prices. So where I get a bit concerned is has the prices run ahead of the reality? I'm not saying that is the case, but I think it's something that's worth watching. So I agree, modernizing the power grid is a structural trend. And I think that choosing the right companies that will benefit from that is important. And I think a lot of them have really skyrocketed. So let's just make sure that the reality of the opportunity meets the price level of the opportunity.
Yuki, we'll get you a microphone right in front.
Hi, Mike. So we saw a lot of active ETF with you and a lot of partners, DoubleLine, Blackstone, Apollo, and Bridgewater. So are you wondering if you are, what can we expect more? And then which area you have in your mind maybe next 3 or 5 years?
Yeah. So State Street and SPDR ETFs has chosen, relative to a lot of others, from a comparable advantage perspective, to partner with managers where we think it's best in class, where we might not have kind of the skill in-house, right? And some managers, they won't admit that or accept that, where we have. And I had a friend that he was at my wedding, and he's in the industry, 27 years ago, and he said to me, "Boy, you have all the right partners." Right, Apollo, Bridgewater, Blackstone, DoubleLine. Whenever I list these, I'm sure one of the partners is in the room and is like, "You didn't list me," right? But so we have a lot of partners where we've launched products. So yes, I would expect that this will continue. Certainly, I think the ETF industry is evolving, and we've seen a lot of that today. And even with what Astoria offers, to outcome-oriented, right? To generate an income, those types of things. To get access to a market maybe they didn't. So of course, earlier in the year, we partnered with Apollo to launch PRIV and PRSD. So expect more kind of thinking about access to private markets or illiquid markets from that standpoint, or providing an outcome either through some type of income or options orientation. That would be, I think, the areas. Now, I'm not the head of product, Mark Alberici is, but I think that's the direction of travel. And it wouldn't surprise me if we were to partner with others, but we want to make sure that there is a real investment challenge and we're meeting that challenge with a solution, with a good partner. And so what we have done in the past, DoubleLine, Blackstone has been successful, All Weather and Bridgewater is off to an incredible start. And look, we have our failures too, so to speak, but some of these things have worked out well, and I would expect us to continue to do more.
Got time for maybe one or two more. If there aren't any
Finishing early
more
probably isn't
questions,
bad either.
maybe we'll take one more question over here. Perfect. Make this the last one.
Yeah, I'll stick around.
Hi, thanks. Going into this earnings season, the expectations for consumer and staples seem to be pretty negative, I guess. What's your thoughts for that sector over the next few quarters?
Yeah, so it's interesting. The consumer is doing reasonably well. From my perspective, consumer staples is a bit of risk here from a couple different perspectives. One, I think the tariffs are impacting some of their kind of cost line, and that's eating into what is already thin margins at a time when staples are expensive relative to their history. So for me, I think we're kind of a bit, we find staples not to be attractive at this point for those reasons. Now, I do think if the market were to suffer a little bit of volatility or decline, folks will gravitate towards the defensive nature of staples. And I would never rule that out, but generally you can tell that we're fairly constructive and bullish going forward. So I think that kind of higher prices and the inability to pass them on to consumers. David Kelly was here talking about kind of that tail of consumers who are, I don't know if struggling is the right term, but certainly are challenged. And that's kind of eating into those profit margins at a time when staples, it's hard to call them inexpensive. So I think they really will only perform well if the economy is cooling and investors are getting worried about a recession. And you've seen that a little bit of late, but I think that that's probably a bit exaggerated at this point.
Any more final questions?
I would just, sorry, one other
Go ahead,
thing.
please.
You mentioned staples. But you introduced earnings season. So let me give a fun little kind of factoid here. So we talked about kind of how the market's expensive, credit spreads, all the stuff, right? And so one of the things that was interesting headed into this earnings season, not for staples specifically, was this was only the 5th time since 2003 that analysts were increasing their earnings expectations headed into the earnings season. So in the previous 4 times, 3 of them, we were in recession and headed out. So they were increasing. In 2005, we were in the middle of a bull market. And so that one worked out just fine. So it'll be interesting. So you'll remember in the second quarter, as a result of the fears about Liberation Day and tariffs, that analysts cut their expectations drastically and the companies blew them away. And that helped fuel the rally, like Dan was saying, around kind of up 35% with very little drawdowns. So the bar has been raised, and the early days are that the companies are stepping over that raised bar, but we'll see as earnings season kind of evolves whether that continues to be true. It's rare that expectations are this high. You put that with positioning that's stretched, valuations that are stretched, and price levels that are high, you could see some kind of tantrums if the results aren't as good as expected. Now, so far, so good, but that is something to keep an eye on. And of course, with earnings season, it's always about what the executives say about the future. They're going to beat the earnings. The question is by how much? By what percentage? How many percentages of the company? By how much are they going to beat? Will that satisfy investors? And then ultimately what they have to say. But that was an interesting kind of shift here that you don't see very often, that analysts were increasing their expectations into the season and could pose a risk as we move forward. I don't know if you want to. There's one more or not.
Is there? Yeah, we'll do it. We'll do one more. Yeah. You got the double
I thought we were
header.
going to finish with 15 minutes
Yeah,
left.
that never happens.
Quick question.
You got a mic
Quarterly
coming.
Versus
Sir.
quarterly earnings or versus twice a year? What do you
Oh, yeah.
guys favor?
As an investor, I want more information, not less. But I kind of understand this notion of trying to kind of get investors to think beyond the next quarter, right? So there's part of that. I remember way back a million years ago, I wrote, there was a pro and con piece in CFA magazine. I wrote one on Reg FD. Remember Reg FD and allowing kind of leveling the playing field for all analysts, where they couldn't cozy up to management and get the kind of the inside scoop and kind of what were the pros and cons of that. As an investor, I want more information all the time from that perspective. So I think quarterly, but I understand kind of the notion behind kind of trying to kind of not have folks overreact in the short term.
Awesome. Well, listen, please join me for thanking Michael for all your great insights.
Thank you so much.
Nice job. Yep.
Thank you, everyone. Which way do we go? This way?